Welcome to this explainer. Let's get right into something super fascinating in the world of finance. We are going to uncover exactly how institutional algorithmic trading separates genuine statistical skill from pure, unadulterated luck. We'll be doing a high-level overview of the really rigorous validation mechanics used by Apex executions. You can kind of think of this as a behind-the-scenes tour of a mathematical obstacle course, a place where weak trading algorithms go to get completely dismantled. All right, let's dive in.
We've all seen them, right? Those trading strategies that look absolutely flawless on paper. The equity curve goes straight up, the drawdowns are tiny, and it honestly just feels like a license to print money. But the harsh reality is that most of these so-called perfect strategies suffer from severe survivorship bias and backtest overfitting. What you're seeing isn't actually a reliable system, it's an illusion. It's a strategy that has essentially memorized the past rather than learning how to actually navigate the future. So the big question is, how do we spot the difference?
Well, that brings us to the core of the problem, the probability of backtest overfit, or PBO. This is the mathematical probability that a strategy's historical success is literally just a lucky artifact of tweaking and searching through too many parameters until you find the exact combination that worked perfectly for historical data. Apex execution solves this illusion by running algorithms through a totally unforgiving obstacle course, where the maximum allowed probability of backtest overfit must remain strictly under 30%. Anything higher, the algorithm gets instantly rejected.
Here is the map of the gauntlet we're about to run today. The lie detectors, the reality simulators, combinatorial purging, optimal sizing, market regimes, and finally, the final boss.
Starting off with Section 1, the lie detectors.
We are diving right into the first set of hurdles, which are specifically designed to catch inflated statistics right out of the gate. You know that common industry metric, the standard Sharpe ratio? It actually lies to you. It naturally inflates with every single parameter trial run. The more you tweak, the higher it goes, which creates a totally false sense of security. To counter this, the system demands a deflated Sharpe ratio. This corrects for the number of trials, as well as extreme market events and lopsided returns, known mathematically as kurtosis and skewness. Basically, it forces the strategy to produce a conservative, honest measure. And to even advance past this stage, an algorithm needs a deflated Sharpe score of 0.60 or higher.
Next up in the lie detector phase is walk-forward validation. Think of this as a super strict anti-peaking mechanic. It splits the historical record into sequential windows. First, you optimize your parameters on in-sample data. Then, and this is absolutely crucial, you freeze those parameters and test them on the following unseen out-of-sample data. No looking back allowed. The platform requires at least a 60% consistency across these unseen windows just to prove the strategy isn't purely curve-fitting the data.
Moving on to Section 2, the reality simulators. Surviving history just isn't enough anymore. How do we survive random storms? By generating over 1,000 alternative price paths. Using a technique called block bootstrap resampling, the system takes the underlying data and generates over 1,000 new resampled scenarios, all while preserving the autocorrelation structure of financial returns. And why this matters is simple. It filters out strategies that only profit from one very specific historical sequence. If your algorithm actually has genuine skill, it needs to perform across all of these randomly generated, yet statistically plausible alternate timelines.
From 1,000 paths, we jump to 10,000. The next layer utilizes Monte Carlo simulations to completely reorder real trade sequences 10,000 times. This builds out empirical distributions for key metrics like your maximum drawdown and profit factor. So instead of giving you a single, potentially super lucky historical number, every metric is presented with 90% confidence intervals. If a strategy shows wide, totally unpredictable confidence intervals here, it gets flagged as being far too dependent on a specific path of luck, meaning it's just too risky for your capital.
Next is Section 3, combinatorial purging. Now we reach Layer 4B, which is arguably the most mathematically intense form of strategy evaluation out there. Enter combinatorially purged cross-validation, or CPCV. It takes the historical record and divides it up into multiple folds. But here is the real genius part. It inserts strict embargo periods right between these data folds. This completely prevents any information leakage from the training set over to the testing set. It then evaluates every single combination of these sets. To pass this layer, the strategy must produce a tight and consistently positive distribution of out-of-sample performance, rather than just squeaking by with a single lucky pass or fail grade.
Pushing forward to Section 4, optimal sizing.
Okay, so an algorithm somehow survives the lie detectors and the reality simulators. Now we have to figure out how to actually deploy it. Layer 6A mathematically calculates exactly how much capital it should risk. To do this, the platform uses the Kelly criterion, which figures out optimal position sizes based on a strategy's win rate, average win, and average loss. But going full Kelly can be incredibly volatile in practice, so the system uses fractional Kelly sizing, typically half Kelly, to account for estimation errors. Furthermore, this is paired with automated circuit breakers. If a strategy breaches predetermined drawdown limits, these circuit breakers immediately step in and halt or demote the strategy. It's basically an automated safety net to protect capital if the market suddenly behaves in a way the algorithm simply didn't expect.
Almost there. Section 5. Market regimes.
A strategy that only works when the market goes straight up is nothing but a bull market passenger, right? Because of this, every strategy's performance is strictly sliced by market regime: bull, bear, and lateral, which is that choppy sideways movement. The crucial point here is that a strategy must show positive expectancy across all of these conditions. If an algorithm concentrates its edge entirely in a single regime, like say it only makes money in a bull market, it gets flagged, demoted, or halted entirely. Absolutely no single regime strategy gets through this gate.
To stress test this adaptability even further, the next layer doesn't just do a basic shuffle of the data. A plain shuffle actually destroys the realistic way that drawdowns cluster in real life. Instead, it simulates 1,000 regime-conditioned equity paths using a Markov chain. This makes sure that the synthetic paths accurately respect how market regimes actually transition in the real world, moving realistically from trending to choppy to highly volatile conditions. It overlays these plausible outcomes directly over the real history the strategy traded through.
And finally, Section 6, the final boss.
All right, so the strategy has cleared every single statistical layer. It's proven it wasn't overfit, it survived thousands of alternate realities, and it can clearly handle different market regimes. But now, it faces the ultimate benchmark. Does it beat doing nothing? I know, it's a simple, almost insulting question, but it's undoubtedly the most important one. A strategy can clear every single statistical gate we just talked about and still ultimately just be a levered bet on the broader market going up. So, to pass this gate, the strategy is ruthlessly backtested against a plain buy and hold of the exact same ticker, factoring in identical costs.
The metric we are hunting for here is alpha. Alpha is the return left over after you subtract market exposure, which is known as beta. To pass this final boss, the strategy must generate an alpha greater than 0%. But it doesn't stop there. That alpha must be rigorously confirmed by a p-value of less than 0.05. In plain English, this mathematically proves with 95% confidence that the edge is real and not just random market noise dressed up as trading skill. No alpha, no pass.
And that brings us to the ultimate result of this entire gauntlet. Because Apex Executions uses no hand-picked results and allows absolutely zero survivorship bias, every single ranking on their leaderboard reflects a mathematically bounded, out-of-sample edge. If a strategy is in the green and actually deployed, it means it has proven infinite regime coverage and truly earned its place by surviving all 6 brutal layers.
This rigorous, unforgiving gauntlet leaves us with a pretty provocative final thought. Think about the trading algorithms, the backtests, or the financial products you might be looking at right now. What hidden disastrous flaws might be lurking inside those unchecked strategies? If your strategy had to run this exact mathematical obstacle course today, would it survive? Or would it be exposed as just another lucky artifact? Thank you so much for joining me on this explainer, and as always, keep questioning the data.